When someone takes out a 30-year home loan, who actually decided it should be 30 years? Like, where did that number even come from?
Well, no homeowner or home buyer sits down and says, I want to be in debt for the next 30 years. So it's structured by the banks, but it's generally because the 30-year loan term makes the monthly repayments more affordable. Look, obviously there's different terms. Yeah, the banking structure doesn't really take into account, a homeowner's retirement plan. Like if you're in debt for 30 years, then it's not really going to help you get to retirement, depending on when you first get into debt, obviously.
Most people can't tell you the exact calendar year that their mortgage actually finishes. Why does that one date matter more than the interest rate itself?
Well, when you first get into a mortgage, you know that that's the term. Obviously, you can restructure along the way. You can rate shop. You can refinance. Like there's different factors. But if you're just into that one commitment, you've also got to take into consideration what your other goals are, retirement plans. So if you get into a mortgage and you're sort of in your mid-50s and it's a 30-year term, do you want to work to 80?
Fair enough. And on that, you often talk about the finish line moving from the age like 52 to 62 in a single generation. What do you think pushed it back a whole decade?
I think just affordability, people being able to come up with a deposit and then actually get into the market. Yeah, life circumstance, like it's just life is probably harder than it was once upon a time. That could be a contributing factor. Also, along the way, do you refinance that mortgage? Does then that make the term start again? So these are sort of some of the contributing factors.
Okay. And if someone doesn't know how that works, for example, you just said if you refinance the mortgage, does that then restart the 30-year term date, generally speaking?
Well, depending on what the new term date. But if you want a 30-year loan again, then start again.
And most people, in your experience, do they do that?
A lot of people do that, but if it's for lifestyle and renovations, buying a car, jet ski, holidays, and so on, that's not a smart strategy or plan. Like, you do. Property goes up annually, 6-7% on average in the right areas. So, you can utilize that equity, but you've got to utilize it more wisely for growing your wealth or your asset base.
Not a Euro summer.
Yeah, look, as long as you can sustain it, but you've got to just be a little bit more smart and tactical about it.
That's fair enough. Well, half of Australians aged, say, 55 to 64 still carry mortgage debt today compared to far fewer a generation ago. Do you think this is a lifestyle spending problem or a structural system problem?
I think it's a mix of both. I think just the banks are designed in a way to load up interest in the early portions of the loan. And then
would that be like the first 5 to 10 years of the loan, do you think? Or
the first 10 years is where you're paying off predominantly interest. And then as you get to the back end of the loan, then you're paying a lot more of the principal down. That's just the way the banks have designed it, unfortunately. And it's something that not a lot of people know until you dig in deep and see the numbers.
Fair enough. All right. When do you think someone with a 30-year, like an original 30-year mortgage, they're an owner-occupier, when do you think that they should start considering, I don't know, accessing equity or looking at their investment structure or their investment plan and as a whole? Are they sitting on a bunch of wealth that they don't really know about?
Yeah, often first home buyers get into the market, sentimental reasons, or obviously the great Australian dream is you want to own your own home. So that's what a lot of young people are taught by their parents: save for your deposit, buy your own home, and you're home proud. Sometimes it's not the smartest choice. However, often indirectly, without doing the research and looking at the data to identify the right areas that are going to grow based on the fundamentals, a lot of owner or first home buyers, owner occupiers actually fall into a good location because it's going to be near, like they don't really know how it happens.
Yeah.
Close to the school, close to their workplace, close to transport, train station, highway, kids, so on. So they're some of the key factors that we look at amongst many others in the checklist or matrix that we look at. But indirectly, they do find a good area that performs. Then, and within 5 years, they've got lazy equity, we call it, which is equity that's accessible. We do with a lot of clients. They don't know that, like they think they're tied to this marriage with the bank for 30 years. We're going to pay it down. And that's what we do, or we're just going to pay it off over the time. But little do they know, over the time of the 30-year term, they're probably paying as much in interest as they paid for the home originally as the purchase price. What smart investors do is tap into some of that, a slither of that equity, use that for the deposit for the next one. And so like that's how they get their investment portfolio going. Equity recycling, which is taking some equity out of the home, as long as it's not on leisure and like lifestyle expenses, then
for the purpose of reinvesting.
For the purpose of reinvesting in property, because
build a portfolio.
That property that they've just had, which is owner occupied property, has just risen in value. So it's a compound effect or snowball effect. Like you can get other properties to do the heavy lifting, and it's the investment properties aren't going to be totally reliant on the investor to service the loan,
because they have tenants.
Large portion comes from the tenants, and then also tax benefits, could be depreciation, negative gearing, and so on. So that's not going to be totally reliant on them, but that will perform, and over time, they get done right, they can get to the next one.
Okay, so then if a listener can only do one thing after this episode, say they're an owner occ, they're in year 18 or 19 maybe of their mortgage, what is the exact question that they need to go home and answer about their own loan tonight?
Yeah. Do I have extra servicing capacity to maybe utilize my asset to do greater things? What are my retirement goals? Like if you're sitting on an untapped resource, there could be a better way. Often we get beginner clients that are like not probably educated in the process, and they feel that, oh no, I'm going to get another property. That's more debt. I'm already struggling to pay off my current debt, but they're
scared of taking that extra asset, not knowing that they wouldn't have to really do much to service it.
Yeah, correct. Look, it could be minimal. It could be $50, $100 a week out of pocket once you take into account some of the tax incentives. So yeah, you got to sometimes zoom out to zoom in and look at the bigger picture, get clear what your actual goals are, and yeah, if you become clear that it's not that great of a burden and it is I can maintain that. Because these assets are actually, I'm going to use the power of leverage to actually grow my wealth. The cash flow over time, as the debt reduces, rents go up as well. In a few years, that asset can actually be bringing, or if not from day one, if it's not neutral to slightly positive, within a few years, that's extra cash flow, extra deductions. That can be diverted back into the actual residential or principal place of resident mortgage, to pay that down quicker.
And the end goal would be to pay your own home loan mortgage down quicker.
Well, that's it. That's bad debt.
Yes.
That's you're not getting any incentives from the ATO to pay that. Any of the interest paid on is not tax deductible. So yeah, the aim is use other assets to actually, like, you obviously need to take some equity out to begin with, but once you get the ball rolling, you can utilize your portfolio to actually pay off your home quicker over time because of the extra cash flow, and you're building wealth.
And do you think people should pay off their home, or aim to pay off their home, well before retirement, or at least by retirement age?
Well, of course, but you're in retirement. You don't want to be. You're not going to be working. You're not going to be able to service a loan. A lot of people are comfortable. They don't want to move from their desired area because then their kids are around, or lifestyle, their golf club, their friends, family. So it's not necessarily you still want to be in a mortgage in that place. Yeah, you can downsize, you can move on, you can cash out and reduce your mortgage if you are left with a balance. However, it's the freedom of choice. If you're happy, you want to pay it off. You don't want an extra burden. You want income producing assets that are actually going to fund your retirement, as opposed to having a liability that's still relying on you in your twilight years, where you should be winding down
in Europe,
enjoying your time on the golf course.
Yeah. After 12 years in accounting, when a family shows you their mortgage statement, what do you see that they completely miss?
Probably the loan term. It's something they just, like, they know they're locked in, but it may not be something they often think about, or how that affects their retirement trajectory. So that's probably the first thing I look at, as well as the balance, just to see, what's left.
How long left?
Yeah, or the main, how long left, what the balance is, and what the monthly repayments are, because I'll be able to automatically know from what sort of income they're earning, like how stretched they are in maintaining this liability.
Okay. The most obvious move is just make extra repayments. Like we've all heard that one before. And you've modeled that standard advice against a strategic property engine over 20 years. But what does that gap look like and why?
Yeah, look, generally the banks give you the minimum repayments when they've got obviously buffers and servicing calculators and so on. So the term of the loan is usually to give you something that's manageable. And then often you might have extra cash, there's an offset account. So any extra savings will sit against the loan to reduce the balance, or old school would just extra repayments, pump down the mortgage. However, yeah, you can pay it off quicker, and then interest on interest, which is like compounding over time, it will reduce the time you pay off the loan, no doubt. However, that's reliant on the individual and to put their hard-earned blood, sweat, and tears into the mortgage. There could be a better way, or there is a better way. The better way is you build your funds and put it into another asset. Your home's an appreciating asset. It's growing. Why not have multiple assets that can grow at the same rate and appreciate, so then you can build your asset base? Like, yes, it's great to pay that off and reduce a fair chunk of interest that you're paying off over time. But I feel the engine is using property that gets you cash flow, that potentially at some point you can pump that back in.
So I'm not just using my income and my wage to now pay down my mortgage. I'm using the positive cash flow from an investment property to add and still pay down my mortgage
tax incentives
faster.
as well, because negative gearing on or deductions on investment properties will actually get you that stronger cash flow and tax savings. That can be utilized in the correct manner to actually help you pay down your mortgage faster. So initially, yeah, that does sound good. I'm gonna knock down my mortgage. I'm gonna go hard. Yeah, that's not a bad strategy, but the better strategy is the power of leverage, using some of your cash to actually get other assets, and then redirect the surplus cash flow. What you were intending in the beginning is put extra repayments in. Yeah, we can get extra repayments at some point when we have a positively geared property. However, that's also going to grow. So it's all about increasing equity on multiple assets as opposed to just being reliant on one asset growing.
So what out-of-pocket costs do people completely forget to factor in when they assume an investment property is going to drain their family budget every week?
So look, you know that the biggest thing when buying an investment, the main factors are going to be that you need to put a deposit in, then you've got a new loan. So how do we maintain that loan on the investment? It's the tenants pay a large portion of it through rent, and then you know you're going to have to pay interest on that loan. So that generally that's the main things are the rent offsetting against the interest and loan repayments and the principal component. That's on you to a certain extent, unless it's in initial years it's going to be like neutral or slightly negative. However, there's a whole heap of expenses. So you're going to have rates, insurance, potentially land tax, management fees. Yeah, there's a whole lot of or strata if it's a strata title property. So these are things that you need to also factor in. So when buying a property, it's very important to get clear on the numbers, how the performance of the property, like what's involved. What if it's an older property? Is there going to be extra maintenance costs that I haven't allowed for? But if it's very old property, like could an air conditioning or hot water system go? They're capital costs. These are things where you need to allow buffers and know exactly what you're in for all income, all expenses, and what your bottom line is going to be, and have contingencies as well.
And that is obviously part of your process when you are talking with potential investors or your clients.
Whenever we present or review properties, clients have bought us properties as well. That once we present properties, they want to do their own
research,
DIY, due diligence, and research, and analyze it side to side, and just show the features and benefits and the performance on a cash flow basis, and then the client's at least more educated and aware of all the moving parts that are required to own an investment property.
Yeah, because they might come to you with something that's like looks cheaper, but it doesn't. It actually requires more ongoing costs than maybe what the other thing that they have seen does, like a side by side comparison, and then you're able to really educate them as to what the ongoing maintenance costs and those out of pocket costs are.
Yeah.
Because do you think people forget about that in their own process or research sometimes?
100%. I had a client today. I won't mention names, but we've presented properties. He loves the area based on the data and the research we've done. But then now he's comparing it against older properties, 10 years old, 15 years old, minimal depreciation benefits. Mind you, the property's not much cheaper than the new builds that we've proposed. Plus, we've done all the due diligence. However, because the project that we've presented hasn't commenced yet, you're only paying stamp duty on the land component, which is like $20,000. Just if he buys a like for like, that is 20, 30K cheaper. He's going to pay that much, 30, 40K more in stamp duty, and you're going to have no warranties from the builder, no minimal depreciation benefits. And these are things that you might have blinkers on sometimes, and unless you go through all the line by line items of the cash flow, these can very easily be missed.
Yeah. So what does an investment property actually need to earn in order for it to be cash flow neutral, meaning it doesn't take any money out of the household budget?
Income has to cover expenses, basically.
Income over expenses. Okay.
Yes. So anything over and above is positively geared. Anything less than, so if expenses outweigh the rent that you're getting, well, then that's negatively geared.
When you say expenses, this is probably off the cuff, but do you say expenses as in you're just looking at the monthly or fortnightly repayments versus whatever the weekly rent is, for example, or do you factor in these extras like strata, etc.?
Yeah, all of the expenses. So we don't take into account the principal repayments because that's not back to my accounting days. That's not an income account. The principal, that's reducing the liability. So that's offsetting against the loan. So however, if you have a property, for example, that's interest only, you would just take into account the interest portion plus any cost associated to the property, rates, insurance, strata, so on. So at the top, the income is the rent less the expenses. Then also just while we're on the topic, a non-cash deduction. So it's not going to affect the bottom line, but you can also get extra incentives from the ATO for depreciation. So if it's a new property, the building will be written off at 2.5% over 40 years. Then the fixture and fittings, which is blinds, kitchen, stove, hot water system, and so on, they will be written off generally over the first 10 to 15 years. So these are extra deductions that can be claimed, but you're not filling it out of pocket.
Why is a higher yielding property actually the safer option when the entire goal of the strategy is protecting and paying down the primary home loan?
Positive cash flow just means that the property is not relying on you. So you've got a surplus, which means that the property is not relying on you tipping in and having to dip into cash that could be sitting against in offset account against your home loan. So if investment property is self-reliant, well, then that gives you more flexibility to not to have the investment property become a burden.
Okay. You deliberately model the worst case scenario for your clients. What conservative assumptions do you build in, and why do you forecast these worse than reality?
Look, the assumptions we put in is just based on what we think the minimum rent is, because we don't and we take into account the vacancy rates as well. So we don't want to. We know a lot of the properties that we help our clients purchase and source in strong areas will actually get a higher rent, especially on completion. But we just model it on today's terms and look at the lower end, because that's what the banks are going to look at when they do their valuations. And if for some reason the climate changes and there's higher vacancy rates, which we actually predict like 1 to 3%. So that's the safe range. So you wouldn't have a problem getting tenants in at that sort of level of vacancy rates. So we try to be very conservative, and that allows when the property is completed and tenanted that would rather under-promise and over-deliver.
Yeah.
So then, we at least know the worst case scenario for the clients. If they had to put tenants in there just to be getting another source of income, that it's still going to be a solid result and it's going to be maintainable.
And you kept saying the word vacancy rates. If I don't know what that means, what would that be?
It just means like if it's 1% for every 100 homes in the market, one is empty.
So it just refers to the amount of vacant homes
Available
area?
homes within any one market. So but it's only vacant for a period of time.
Yeah.
Like people obviously come and go. It refers to sort of listings on market as well.
Great. What is a quick calculation that someone could run tonight to see roughly what year their loan could actually finish?
Look, you don't have to know the actual details around your loan, but there are like online calculators where you can just do some assumptions. Like if you're going to be putting extra repayments, or you're on the minimum repayment and you're on a 30-year term, but you can sustain an extra $5,000 a month. Online, most of the major banks have it. Like online calculators will allow you to put the extra repayments, and that will automatically give you how many years you will save off the actual loan term. So it's pretty accessible, like to be able to do that calculation.
You say there is a second income hiding in most people's homes. What do you mean by that? And how does equity become an income stream without needing new cash?
Well, the second income, we touched upon this before, is not knowing how to utilize the lazy equity in your home. So that's just by tapping into a slice of the pie. As long as you can still service a lot, like obviously you get into a house, you from day one you start paying down. In most cases, you just pay down some principal, so you already got debt reduction. But then the asset is actually going north because it's getting growth. So all of a sudden you got a larger portion of equity that you can potentially play with. So as long as your income or your circumstances allow it, that should mean that you can actually utilize some of that asset to actually purchase other assets. The other assets will also have rental income coming in. So it wouldn't just be relying on your PAYG income or what you're earning if you have your own business. They'd also take into the banks or lenders also take into consideration the proposed property that you're going to be purchasing, as that income also being added to your current income to allow for stronger borrowing power.
Right.
So what your house would allow you to do is the power of leverage. You could control other assets that are also going to grow similar to your home.
Walk us through the three engines. So you've got rent, tax depreciation, and equity growth. How do they stack together to target the home loan? Well,
the rent is just a good portion of what the loan interest repayments are going to be annually. For an investor, in most cases, a large part of the pie or the liability is paid down by the investor. So that's number one. You can offset any deductions from a rental property against your personal income if it's in your personal name, obviously.
Okay.
So that will give you tax incentives. So often property may look from a cash in, cash out perspective as if it's negatively geared. But if you've got a couple that are high income earners and paying tax in the higher tax bracket, that negative gearing for the year, call it a couple $100 a week, possibly, depending on the property type. If they're in the higher tax bracket, the portion of negative gearing can actually be offset with similar portion of tax savings. So the property wouldn't actually be reliant on the individual. Like it would show a loss, but then you can actually do a deed of variation with the ATO, which would mean that your employer reports less tax on a weekly basis, and then you've actually got a higher net income, so you can actually sustain the property. Look, through tax savings. Everyone feels like they're paying too much tax. That's one of a lot of clients come to us like, how do I give the government less? So no, I'm not sure about the roads around where you live, Sarah, but I've still got potholes around, so I think my hard-earned tax-paying dollars could be better allocated, or even better back in my pocket.
Fair enough. This is a good one. So if this strategy that you use works so well, why isn't everyone do it? Why aren't they all doing it for themselves? What do you think the honest answer is?
Well, this is it's not directly related to property. It's fear. Fear of doing it wrong. paralysis analysis. What do I do? Where do I buy? And often clients, I'll speak to a client and they'll go, do you remember me? We spoke about 5 years ago and I was looking at such and such, and far out, I should have bought in Pallara, Queensland. I had one the other day.
Yeah.
I said, okay. But then I realized, so we get into the process and then those same fears are still there because they're still hesitant, and it's our job it's like we can educate on property, numbers, source, but if someone can't get past those limiting beliefs, that's the biggest obstacle. So what our whole journey is, it's transformational. It's just about working with clients to see what is possible, vision building, and more than anything is just giving confidence that what they're doing is the right decision and it's going to change their future. So I think if we track back to what the question was, why aren't people doing it? There are mum and dad investors or DIYers that are doing it. But the people that aren't doing it, it's not because the system's overcomplicated. There's nuances to it, right? However, I think a lot of it's just fear. And also some people don't, there may be other commitments in life that take a priority. To me, I think the biggest priority is taking care of your financial future and having freedom. So it might seem like a big jump initially if you're a first-time investor or haven't done it before, but it's definitely something that can be overcome, and you can actually. So it's clients that I've worked with. There's a few clients, Vince to think of one. It took a year or so for him to get comfortable, and when he went, then he wanted another one and another one. He got a taste for it, and then he enthralled himself with everything property. He rings me weekly just to tell me. He educates me. so there's no. It's just taking that first step.
Yeah. Do you think most people assume that it is mainly like high income earners? It's actually not the average mum and dad kind of family household investing, and that's something. I mean, you've seen it. You work with those people, but do you think there is an assumption that I don't earn a certain amount of money, therefore I'm not eligible, like as a limiting belief?
I think so. I've seen like very modest clients just do great. It's just they've been able to compound, save hard, let the assets, pick the right assets. Yeah, and you don't have to pick expensive assets. It doesn't have to be Rolls Royce. You can, just do what's within reach. If you've got a beer budget, stick to a beer budget, and don't go for champagne because it's not gonna work. So it's time in the market. So in my opinion, clients keep saying, I want to keep saving, but if you've got sufficient deposit, just realign your predetermined expectations and look at something that's more affordable that can get you into the market now. Because it's opportunity cost. By waiting another year or two and getting some more savings, what has this lower price point market done in that meantime? Often that could get you a couple $100,000 within a couple of years while you've waited. Yeah. So I don't know, Sarah, would you be willing to leave that on the table?
Absolutely not. Remember that time we were looking at land, and it was Southwest Sydney, and we went, we're selling these places, and then realised we should have just bought one ourselves.
My wife, Melissa, tells me all the time when I tell her case studies, why didn't we buy one of those?
Why didn't we buy one of those? Because you're so focused on trying to help other people and educate them.
But unfortunately, there's not a limited well of funds as well. 100%. So even myself, I have to do things strategically.
Yeah. So. Great. Why would you buy a brand new build specifically? Like, what does a new build unlock regarding tax depreciation and de-risking that an existing property doesn't?
So with the new budget, this has been game changer in May, the 12th of May to be specific. Secondhand properties will no longer get negative gearing benefits. Okay. So interests, whatever the performance of the property, if the expenses exceed the income, then that's not going to be able to be offset against your taxable income.
And that you could do that prior to May.
You could do that
year?
Before, yeah. So look, obviously from day one, 2019, when we kicked things off, new builds has been our primary focus as opposed to a straight out buyer's agent who looks at existing secondhand properties. We've stuck to the new build space because I've got past experience. I've got my builder's license in New South Wales, and we knew the space well, and we work with other builders and developers Australia-wide because we believed in the warranties from the builder, minimal depreciation if you just buy, stamp duty if you just buying the land. You get maximum depreciation benefits. So these are things that we've believed in. So the depreciation can be offset against tax because it's a non-cash deduction. So that's the strategy that we've believed in. But now the government has actually rewarded new builds because of the housing crisis.
That was going to be my next question. Why is the government sort of incentivizing, or why would they why maybe people are skeptical of that? Like, why would the government want to incentivize me to buy and invest in property? It sounds like a little bit of there's something hidden, but it's not. It's the housing crisis, as you just mentioned.
Yeah, we're in New South Wales alone. We've got like 8,000 dwellings short per annum, 50,000 new dwellings. There's a gap per annum of 50,000 new dwellings that need to be built. They're crying out, and the government's, on the other hand, they're wanting to remove red tape so you can get more approvals through.
Yeah.
But I've been doing DA approvals and nothing's really changing from a bureaucratic point of view.
Yeah.
So I don't think that's any more streamlined. However, overall, to take away that incentive of the negative gearing from investors buying secondhand properties, we've already seen it, like a lot more inquiry, a lot more people reaching out because they can still get benefits from new builds now. So I think new versus secondhand being the enemy is no longer the game that we're playing. Often clients wouldn't realize, they'd say, I want something where tenants are there straight away.
Yeah. Is that the main theory behind
that? I think that's why a lot of people, the fear of going through a build process, thinking that it's going to be more of a burden when they actually whatever you pay in holding costs to get through construction, you're already saving at the front end, because if you buy, you buy a house at $700,000, already completed, established, 10 years old, you probably pay $40,000 on that in stamp duty on that purchase. If you bought just land at half that value and then the other half goes to the build, you probably pay $10,000-15,000. The construction is only going to, the holding cost for 8 months, 2 months for approval or permit, and then 5 to 6 months to build. That's only going to be $20,000 in interest. So you've already saved it, because if you would have bought the secondhand property over here, you would have been paying $40,000 off the get-go. So if you're only paying $10,000-15,000, keep those savings aside and use that to get you through the build. Then you're going to get maximum, you're going to attract the best tenants, because at the highest rent, people want to live in a new build.
They want you,
so you've got higher demand. You're in a growth area in most cases where there's more infrastructure, government spending, and these areas being well planned and thought out with connectivity around business hubs or industrial areas. So that's the benefit of new builds. So just because we have a shortage, basically, the government said, okay, let's incentivize people to help overcome this problem. We also have, last year we had 301,000 migrants come into Australia. Where are they going to live? There's already a strained market with vacancy rates at an all-time low in across the country. A lot of suburbs, 1%. If you've got to go to get a property, if you've got to be one of 50, 60 applicants, and there's not enough homes, it's supply and demand. There's just an outcry for more new homes to be built. My opinion is that's why this new legislation has been brought in, to try and overcome the problem.
Right. So the cash flow engine is often like a co-living build. What is the real operational difference between a co-living, a dual key, and just a traditional rooming house?
So a co-living property is a room share accommodation. It's just multiple tenants in common living in one house. They've got their own bedroom, ensuite, lock-up area. In some cases, the large rooming houses sort of have their own kitchenette, stove where they can prepare meals. There's a common area kitchen. So those sort of homes provide affordability. And as I said earlier, there's a housing crisis, so just provides more beds, but more than anything, cost of living is high. Just gives sort of micro suites, micro units in areas that need it. Like, for example, there could be hospitals close by. So you've got healthcare workers, nurses, doctors that would occupy these homes. It's so that will give you opportunity to create a higher yield, but because each room overall you get a higher rate of return on the property. Expenses may be more because the owner or investor that owns the property has some extra overheads, electricity, internet, waste, cleaning, and so on. So yeah, it looks very attractive from a high level. But really the bottom line is more cash flow positive and more often than not. So that's high yielding asset number one, co-living. Dual key is like a one title, like a house similar to a duplex, a house and granny flat combined or detached, depending on the location. That just gives you multiple rents. So that's obviously that's going to mitigate tenancy risk because at any one time, if a tenant moves out, you're still going to get a source of income. But overall, you're going to get a great bottom line because you've got two rents coming in. The traditional build, there's still a great place. And when I show my clients all three options, a lot of the time they're just more comfortable going like traditional because, yeah, it might be in earlier years, it might show slightly out of pocket or negatively geared. But when you take into consideration the tax incentives and the way that can be offset, it's still, manageable. It's still a good position and you're getting, a lot less tax payable.
And it's kind of funny because I feel like co-living sounds like it attracts more individual like income earners or like professionals. And then you've got the dual living versus the traditional house, which sounds more family-like. So when you're looking at, 3 or 4 incomes versus just the one income of that entire family, co-living in that sense sounds like kind of the more attractive option.
Well, it is. Often a lot of clients come to us for that, but then when we work through it,
the numbers, of course.
Just because there's other things to take into consideration, the management structure, you need to add furniture to the home, 25K to 50K, depending on the size of the house. They're 3 to 9 bedrooms, depending on the state. So I think the moving part, it looks good. It's very attractive and it's worth considering, but it's not for everyone.
So who manages the 5 or 3 or 4 different tenants?
We've got specialist managing agents in each state that we've worked with ongoing for a long time and collaborate with. And because we need to, source the property for the client, project manage the whole build, help them at the back end with actually filling the home. So that's very early on. When we get to the back end of the build, we'll make an introduction to one of our recommended management partners, and then they'll take over. They'll keep us informed, and we'll make sure that from day one, there's no lag period in getting some rental income in to make sure the property is performing from the very get-go.
And that's all related to when you're buying the property, but when it comes time to sell a co-living property, who would actually buy a co-living property, and is it harder to exit than like a residual home?
Depending on the specific design and the number of rooms, often they're a dual purpose home. They're a hybrid. So they've got multiple living areas, en suites in each bedroom. Like if it was a 4-bedroom with 4 en suites, I can tell you now, I've got 3 daughters and a wife, and they're always fighting over the bathroom. So
you'd buy it.
And it's got multiple lounge rooms. So my current home, I've got multiple living areas, spacious. So it would work. That's your fallback. You're not overcapitalizing. We've helped clients with other assets that they need a specific fit out, such as NDIS, SDO homes previously. These are not the same sort of thing. I think they're very nice family homes if you want to utilize it as that, but you got the freedom of choice. So in that case, look, generally you don't, you would aim to all segments of the market with a 3 to 5 bedroom home. When you go above that, it's a bit more of a commercial build. So that probably would be more investor focused for an exit strategy. However, if you've got a high property like a 9-bedroom rooming house, we'll be netting 50K per annum.
Sounds like an Airbnb or
so
something.
You'd have like fund managers wanting to buy them, anything that can get their clients a rate of return. But more so investors, and you wouldn't have a problem with a high income producing cash flow property such as a rooming house.
And so when should someone genuinely walk away from this strategy and decide, okay, this isn't right for them? Because as you said, it can be attractive, but it's not going to be for everyone.
Look, it's about risk tolerance a little bit. It's about what deposit they have on hand, how much funds they can utilize. Often it's a different structure, how you fund these properties. The larger ones are actually a commercial lend, so you need to put in a larger deposit, generally 30%. So there's some moving parts and price point. So it's not like we've got to design a strategy or be very bespoke to an individual before saying, yeah, you can do this. Like it's often, clients would come for that, but then maybe a dual key or a traditional. If we're looking for a capital growth play, then you wouldn't be looking to a rooming house specifically. That would get you a better cash flow, but you got to find the right balance depending on an individual's requirements and what they actually want to achieve.
So how do you calculate someone's real sustainable borrowing capacity rather than an inflated number that the banks might tease them with?
The real sustainable, look, at the moment, there's a debt to income ratio, like sort of 5 times your gross income, but then you've got to dig a bit deeper with dependents, what liabilities, credit cards, etc. So rule of thumb, when a client comes to us, we'll look at it from a high level just to say, okay, you've got sufficient savings, you're both employed, you've got sustainability in your job, you've been working for the current employer 4 or 5 years, your wife's in the same situation. So we know that the client with that sort of scenario has stability.
Yep. But
then we'll run a high level, but then we don't do finance in-house. We work with finance specialists and partners we've worked with for years. We just like to stick to our lane, which is strategy, research, and then sourcing properties and then project manage the process from end to end. So it's about being conservative, right? Like we don't know, like interest rates are a little bit unpredictable. You can get a gauge for what sort of climate you're in. But I just think the banks already have buffers that are incorporated into their assessment. So generally, if it passes the test with a mortgage broker that has access to 60, 70 different lenders and best practices, they'll give multiple loan choices, that gives us strong verification that it's going to work and it's safe to work because of those buffers that the lenders already have in place.
So what are viable options when a primary bank says no, or like a family is really at the limit with their borrowing capacity? They might be eager to invest, but financially the bank has said no.
Look, if the bank says no, not every lender has the same policy.
Okay. So
a bank may say no, the big four and so on, because they're looking at a person's situation through one lens based on their stringent policy. Mm-hmm. That's where there's a space for second and third tier lenders. So they'll look at things subjectively and have a different policy. So some may take into consideration low doc loans based on limited information. Some lenders may have just a different way of looking at it. It's not necessarily to say that this client can't do it, but like a sole trader or a business owner, they may need to show different information that one lender their policy it's not a right fit. Mm-hmm. However, it doesn't mean that they can't do it, but going through a licensed professional, it's going to tell you that, you can, or you can't, or let's look at other options and go down this path to make it happen. Either way, if you can get finance through a second-tier lender, it's not the end of the world. Mm-hmm. It's just a solution, and it means that you don't miss out and actually can fast-track your plans.
How do you safely turn non-deductible home loan debt into deductible investment debt? And where do you see that move typically goes wrong?
This involves equity recycling, which is tapping into your equity to utilize to invest. We often see it go wrong where it's a bit of a mix. You don't use those funds just for investing.
How exactly does splitting land and construction contracts save a buyer real-time money during the process?
Splitting land and the real-time money or the main saving is upfront. So if you just get the land and then you do the build, then we touched upon this before, you're saving significant stamp duty. You've got some holding costs and you've throughout that period, but you're getting a brand new asset. And any of those holding costs that throughout the build period, 6, 7, 8 months, will actually already have been saved at the front end. So you can utilize those savings to actually get through the build. And you've got a brand new asset that you can maximize depreciation benefits and have the 7-year warranty on the build, structural guarantee, less maintenance costs. So it's a worthwhile scenario to go through. And more than anything, as we discussed before, new builds, the only assets that get negative gearing now. So it's a win-win. I feel that you can maximize the asset. You're not out of pocket by any means. When you do a cost-benefit analysis, you're actually saving at the front end, which allows you to get through the build if it's a split contract.
And how does a tax variation put money back into the household budget weekly rather than waiting for like the end of year return? And what kind of dollars are we actually talking about?
Yeah, well, look, in most cases, if you've got a property and once we crunch the numbers, most of the time the tax incentives through negative gearing and the depreciation, which may be 15 to 20K, a non-cash deduction on the property, those deductions are going to offset against the taxable income, which will mean that you can have nearly the same amount in tax savings as you would be negative. So it's a contra effect. They offset one another. Instead of waiting to get that lump sum at the end of the year when you do your tax return, like now's like sort of end of financial year, everyone's ringing up their accountant, trying to get a little bit of a win. So with a deed of variation, you don't have to wait for that lump sum at the end. You just lodge a deed of variation with the ATO, and you can actually apportion, like let's just say you're getting 5,200 back in a tax return at the end of the year. When you do the deed of variation, that will pretty much split that refund throughout the year. So your employer might take $100 less out of your wage a week, so you get a higher net pay, which means more cash flow, and you can support the property and offset. So you're not waiting for that contract to happen at the end. You get it throughout.
Okay. So what does your engagement fee actually buy for a potential client, and why is it like a fraction of the size of a buyer's agent fee?
Yeah. So when a client engages us, we'll kick off their strategy from the very get-go. That's mapping out a game plan, doing the research for them, providing the data and analysis of certain areas that we're recommending. We actually even go and get our boots on the ground in different states to see the locations firsthand. So they're getting access to us. They're getting access to our relationships that we've built over the last 8 years, wholesale pricing from our build and development partners that they can't negotiate with retail, or the general public won't have access to some of the opportunities that we have access to through our relationships. And we project manage the whole process. So we'll take care of it end to end. We'll do all the heavy lifting. And then even to at settlement or when the property is completed, we will introduce them to our managing partners. It's only a fraction of the cost because it is for our time up front. And we look at it as more having skin in the game and a commitment fee. So it's the clients that engage us and then have that level of commitment. They're the ones that move forward. They're the ones that are doing it. Whenever we didn't have a engagement fee or service fee, a fee at the front end, that's where it was wishy-washy. Would work with clients that weren't the right fit to work with, spending a lot of time, and they're not motivated. So just gets us working with the best clients, and it's for our upfront time. Obviously, it's not as much as a buyer's agent fee because they don't get remunerated on the back end with our partners. Should we help a client with a new build, then we get a referral fee at the back end from our partners. So we don't have to charge as much at the front end because the builders and developers will pay it to us instead of the client having to pay it to us.
When is it doing it yourself genuinely the right move? And when does the DIY quietly cost more than it actually saves?
Okay. So look, there's a place if you can get it right. Like we're not saying that there's not great assets out there that are established or secondhand properties. It's just that if you don't know what you're doing, it's the picking the wrong location. And we've actually guided clients through locations. I've got 3 that come to mind, and then they've just gone and used our research to go and find the secondhand property. However, they're not looking at the age of the property. They're not looking at how much depreciation benefits have got left. There's multiple factors. They're not understanding all the dynamics of the property itself. So people can pinch our information. We give away a lot of value for free anyhow. So where they could come wrong, unforeseen repairs and maintenance, capital costs that can't be tax deductible. And with established properties, there's no longer any negative gearing benefits. So that's in itself means it's very no tax deductions. I think that's a large benefit's been taken away from that space in the market.
And in the case of DIY, I mean, you might have potentially experienced renovations in the past. When do people actually stick to a budget, or do you often find they go way over budget than what they were initially expecting if they try to do it themselves?
Yeah, look, they wouldn't have access to trades in a lot of cases. They may be dealing in locations where they reside, interstate, could become logistically very, very challenging. And like you said, your budgets can definitely blow out. Or things they like, they start doing something, then realize you need underpinning, or there's more than meets the eye. Even though they might get a building and pest report, you don't know until you start getting into things that actually there's more works that are required that you weren't anticipating.
Right. So how do you select your build partners?
So we vet all our build partners. We look at their corporate profile. We look at how long they've been in the game. We look at their jobs. We walk through some of their completed projects, and more than anything, over time that's been one of our strengths, just building relationships and selecting the right builders. Most of the builders that we build with have already got long-term existing relationships. It's just often probably the project when it's like townhouses or single park contract sort of stuff. That's more boutique developers that we work with. So we've got to really go through the capacity, what they've done previously, how long they've been around, meet with them, and we'll do our own due diligence. So that's, as I feel, we've always worked with good builders and always had a good outcome for our clients that they've completed in a timely fashion and to a high level of quality. Clients are actually protected also under the HIA build contract. Like, should something go wrong, they're actually protected anyhow. Not that we don't aim for anything to go wrong, but it's always good for us to know that the fallback is builders are actually, their license is at jeopardy, but obviously we want to mitigate that at the very beginning.
Another way to ask it is, would you recommend these builders and dedevelopers to your friends, family, and have they ever purchased from you? That's a nice way to test it.
Correct. Yeah, a lot of family and friends have purchased. They're the ones that we aim to get all our clients good results, but anyone that comes to Agenzia is part of our family. So, question was again?
I was going to say, basically, if you would if it's a build partner that you would trust enough to buy it yourself, or trust to recommend it to a family or friend, then that sort of speaks volume.
Yeah, well, look, obviously we've got to put our name to it whenever we select a project or a new build. Actually, because we work so closely with our main builders, it's daily relationships, daily calls, daily catch-ups. So, it's very tight, knit, the actual relationships that we have. And we actually become really good friends with our BDMs and people that we work with within the industry. So that's actually an enjoyable part of the job. But also we place a lot of trust in them. And I think just similar to our clients place trust in us, we need to really know who we're working with. But the builders we work with, they've delivered over and over again, so we've got no issues there.
Next one. What exact questions should a consumer ask when they're first dealing with a property advisory company, like including your own?
I guess what they should ask is, what can you do for me? Like, what is your service? Get very clear on what the service offering is. Not deal with just stock pushers or someone that's salesy and just trying to flog stock that they get a higher commission on, or project marketers, because project marketers are just trying to sell out their own project or multiple projects. So that's not really in the client's best interest. What sort of access do you have? Where do you operate? But more than anything, it's about what strategy do you work on? Like, what is the customer journey? What does that look like? What results have you got your clients previously? Case studies, a social proof, verification. All of these are the things that the clients ask us. Well, not all clients are that diligent, but I would definitely, you want to see a track record of a partner. And people work with people. It's not just people that they like, but people buy people, right? So whoever you're speaking with, ask yourself, this is going to be a long-term relationship. Ask yourself, is this the right fit? can I see myself continuing to
Deal
this
with
person ongoing?
Mm.
And can they get me the results like that they're promising? So as long as you have a bit of a checklist that you can run through, don't just go on gut, but do your due diligence. Like whether it's us or another company, just got to be comfortable because it's a big decision you're making, especially if you're a first time buyer. You got to get the foundations right and make sure that you have confidence.
So in almost every couple, there is a cautious partner and then a keen partner. What does the cautious, risk-adverse partner need to hear?
Look, obviously everyone's got their own disc profile or way that they like to be communicated with. Myself, as an example, I'm a bit of a shiny toy syndrome on the left quadrant of the profile, very optimistic, very trusting. So yeah, I often do get some clients that mirror me, and that's why we get on. But then you can't, like, you need to have both decision makers present in our meetings because it's not going to go anywhere if just one partner's continually attending and they're all in.
Yeah.
Often the stumbling block becomes when the partner jumps on and they're not involved from the very beginning and they're not privy to all the information. So I find it's not about what they've got to hear. They just got to be there from the beginning. They've got to hear the whole strategy, the whole process. When we analyze, look, so part of what we do, as I said before, it's a transformational journey. It's understanding the client. We're not going to jump straight to property. It's about knowing what their fears are, what makes them tick. So what they've done previously that may have failed, what could be contributing towards getting it wrong again. Like there's all of these emotions that come with property investing. Like it's so, and everyone's built differently. So the question, what do they need to hear? It's not about sugarcoating it or giving them the reassurance, but it's about helping them open their eyes. What is possible, building a vision and getting to know what the end goal is, what the North Star is that's driving them. So if that's more time with family, more holidays, a new car, whatever it may be, everyone has a different driver or motivator. Some people like nice things. Some people just want their time back, freedom. So once I feel that there's alignment between first of all, we help the couple align because that like in marriages, not everyone's always in sync, but more so, it's a risk tolerance. One's the husband could be a risk taker, the wife's more conservative, analytical. We need to present to them. Well, it's not that we present anything.
Align them
We
first.
need to provide them with the right information in a way that is digestible to how they both think or interpret the information. So it's just about understanding why they're there and what makes them tick.
And if someone is 47 years old and has, let's say, 20 years left on their mortgage, do you think they have left it too late to develop a strategy?
Well, no, it's never too late. It's never too late. I think you do need time in the market. 20 years is a good amount of time to actually get some good traction and being able to move the needle and plan for retirement. Obviously, the longer you've got, the better. But it's never too late. You can still achieve something, but whether it's in line with what your expectations are. When's the best time to plant a tree?
I know the answer, but you say the phrase.
20 years ago.
20 years ago.
When's the second best time to plant a tree?
Is it yesterday or today?
Yesterday's even better than today. So I think that's an old Chinese proverb.
What separates families who take action and, actually do the investing on the strategy versus the ones who will think about it today and then won't do anything for the next 5 years? Like, what do you think is the key difference between those two?
Look, you're not going to convert it. You're not going to get everyone to see the benefits of doing it now. What separates them, I think, just decisiveness. Like it's removing the noise, getting comfortable with the uncomfortable. Like no one springs out of bed and says, I want to get into debt. Yeah. But looking at the big picture and realizing that you can achieve your goals if you take action.
Great. You have transitioned your focus to a mortgage-free mission. Why this specific strategy and why do you think it's so critical in right now?
Look, we've identified that a lot of people don't know what they don't know.
Mhm.
They just feel like they're stuck in the cycle of, I get into this partnership with the bank and then I'm locked in for 30 years. We want to educate people, show them there's a better way. And the better way is to utilize property to help with that by getting more cash flow, more tax incentives that you can offset. So look, there's just a few things, like obviously structuring of the loans and the offset accounts and changing the payment frequency and every so often refinancing if you can get a better rate. There's we've got a whole list of things that we can help with how to reduce the mortgage. But obviously we're a property advisory service. We believe in property and growing wealth through property. But we believe that's a vehicle that can actually assist with paying down the home. Often as well, we want to open people's eyes to like, you're working hard to just smash that mortgage down. That's old school thinking.
Mm-hmm.
There's a better way to think about it, that I can utilize the equity there and I can use that to actually have the power of leverage and the compound effect of other assets and through equity recycling, doing their thing. So it's our mission to get you out of that trap of feeling stuck. Can pay off multiple houses with what you're paying off in one term of the loan.
Mm-hmm.
All you have to do is be a little bit more strategic, put some plans in place. And that's now the gap in the market is because we also realize that whilst we work with a range of clients from over the years, it's been first home buyers, first time investors, rent investors, sophisticated investors, somewhere in between, someone that's got one or two investments and wants to scale, take it to the next level. We've realized, whilst we like working with everyone and you can't pick and choose, we've realized that the blue collar workers, the inexperienced people that might own their own home, but it feels like a grind. They feel like they're stuck and they don't know a way out. We've realized that that's our ideal client to work with because there's just, like I said, we've got good clients or throughout the spectrum, but they're the ones that genuinely need help.
Yeah.
And they're the ones we can feel that we know we can help and we get satisfaction from that. It's very rewarding, actually.
Great. What should every mortgage holder in Australia believe about their own loan as they walk away from this series?
Your current mortgage finish date is not compulsory.
I like that.
It's simply an outcome that's been predetermined by the banks, and we can change that. You like nothing's set in stone. With some creative planning and strategies put in place, you can be in control of your own destiny.
Do you think people don't realize how much interest they actually pay over the lifetime of a 30-year loan, and therefore they don't sometimes feel stressed or incentivized to then pay it down faster?
Yeah, it's manageable work. You know you're going to get an asset at the end.
Yeah.
It's like paying rent, sort of. You are getting some benefit. Don't get me wrong, but I think in the finer print when you first sign up for a loan, it does tell you like what interest you pay over the term. Obviously, there's some moving factors here, like interest rates up and down and whatever. But if you had a purely fixed loan at the very beginning, you know, in the loan docs what the interest is over that period.
So, would you suggest they go home tonight, look at how much there was at the start? And it's kind of a shocking number to maybe.
Yeah, just think like, are you working to get, you're getting one house, but when you look at it over that time, how would you feel if you could have got two and you're leaving one on the table because it's dead money, interest money, the banks are banking billions. If you can shortcut that and pay a good portion less, like I'm not going to say you can avoid interest totally, but you use it to grow your wealth and use it so it can be tax deductible as well.